Warm welcome to Policy Exchange this morning. We're waiting for Mr. Mills, who's going to kick us off, and I think he's got 1 or 2 minutes to actually get here and still be on time. So we're almost ready to get going, and I think he's just around the corner. My name is Warwick Lightfoot. I'm the Head of Economics and Social Policy here at Policy Exchange, and he's going to lead us in a discussion about the role of the exchange rate in the economy and the extent to which it can be used as an active part of policy to rebalance the economy and stimulate economic growth. We're also going to be helped by Professor Phil Wyman, who's a local from Central Lancashire University, and he has a lot of experience both in the trade movement and brings, I think, a broader, I don't think I'm producing you, Keynesian perspective, and one that's rooted in having worked and lived in Scandinavia. And we also hope to be joined by Tony Travers from the LSC, who runs the public sector local government unit there. And then at the end of the opening chats, I'm going to ask Vicky Price, the former joint head of the Government Economic Service. She's had so many economic roles and so many guises, it doesn't make any sense to actually go through them. We both at different stages worked at the Royal Bank of Scotland, and there's a Venn diagram of friends whom we have in common. And she will collectively mark all our homework before we have a broader discussion. And I very much want to thank John Mills for supporting us today, making this actually happen and coming to open it up. John is an unusual figure within the Labour Party and also within the wider group of economists who take an interest in political economy, in that he's got a lot of local government experience, and he's also got a lot of direct business experience of running a very substantial export and import company, which is, I think, one of the most successful companies of that kind in the world, and has spent a lot of time thinking about the exchange rate and the role that economies can use exchange rates, not just part of a form of adjustment to an economic shock, but as an active instrument of policy. And he's worked on this for many years. He's written very widely about it, and he helped Policy Exchange put together this paper, where Chris Bickerton from Cambridge led off a discussion of those things. And as part of our agenda of exploring the things that contribute to prosperity, Policy Exchange is very keen to explore these ideas and greatly welcomes John's support and participation. Now, John, could you bear to lead us off in what you think we should be talking about in relation to this issue?
Very happy to do that. I think the starting point is to just look back to the last 10 years and to realise that although there's been a bit of growth in the UK economy, most people, more than 50% of the population, have received no real wage increases at all for the last 10 years. And I think that if we carry on the way we are, there's a very real prospect that the next 10 years are going to be as bad as the last 10 years in that sense. And I think that the economic and social and political implications of that are really dire. So I think it's really very important that we get the growth rate up if we possibly can. Now, why is the growth rate in the UK so relatively low? It's been 1.4% per annum for the last 10 years, compared to a world average of 3.5% and much higher figures than that in places like China. And I think the reason is partly to do with education and training and all the supply side issues that you hear people talking about all the time. But much the biggest single reason is because the amount of investment that the UK economy does every year is far below the world average. It's about 16% of GDP compared to 26% is the world average and about 45% in China. But not only do we invest too little, we invest in the wrong things. It isn't true that all investment produces the same sort of returns. Some investment is far, far more productive than others. And the most productive forms of investment are essentially technology, mechanisation and power. Most investment in the public sector, however socially desirable it is, doesn't increase the growth rate. That's true of investment in roads and rail very largely, schools, hospitals, housing, public buildings, and the same is true of large amounts of investment in the private sector, in office malls, in new restaurants, in office blocks, even in technology, in IT. And if you look at the breakdown of the British investment record over the last few years, our investment in technology, mechanisation and power is so low that by the time you take off depreciation, nothing is left. And that is essentially the reason why the economy is growing so slowly. Now, what can we do about it? Well, the problem is that most of the really high-powered investment that does stoke up economic growth is in the private sector. And most of that is in the internationally tradable private sector. And the problem is that most of the investments that might be made are unprofitable in this country because we charge out the overhead costs of manufacturing in the UK at far too high a level. And that is essentially an exchange rate problem. Now, the problem we've got in this country is that we've got a very effective service sector with large export services, and we've got a very weak manufacturing sector which has a huge balance of payments deficit. And the difficulty we've got is that the exchange rates that work perfectly well for the service sector, maybe $1.50 to the pound, are absolutely lethal for manufacturing. Now, this wouldn't matter so much if services weren't so, or manufacturing rather, wasn't so important in terms of our foreign payment balance. But actually, if you look at that, a majority of what we export, even now, even though the economy is 80% services, the majority of what we export is goods rather than services. And key to getting the balance of payments under control, we've got a huge deficit running every year, averaging about £100 million a year, is to sell more manufacturers abroad. And the crucial issue there is to get manufacturing investment up, and the proportion of GDP coming from investment from manufacturing, which has fallen from about 30% as late as 1970 to less than 10% now, back to something like 15%. And I think you could do it if you had a low enough exchange rate. And what is so critical about the exchange rate is this, that if you do have a bit lower exchange rate, existing capacity will be increased and used up a little bit to increase exports. And you've seen something of that over the last year or two, since the Brexit vote in 2016. But what is not going to happen is you're not going to get large amounts of investment in new plant rather than just getting a bit more out of existing plant. What you need to get investment in manufacturing on a large scale in this country is an exchange rate which is low enough for if somebody wants to invest in the new plastics factory or something, it's cheaper to do it here than it is in China or in Germany or Holland. And incidentally, this hasn't got to do with wage rates. If you look at what happens in Holland and Germany, wage rates are at least as high as they are in the UK. This is an exchange rate issue. It's a question about what you charge your overhead costs out. So my message to you this morning is this, that if we're going to avoid another 10 years of very low economic growth and no increase in living standards for most people, you have to look at the exchange rate, not just simply as a way of reacting to events, but as a really important economic tool. And I just conclude by saying this, that if you think this is a really strange idea with no currency anywhere else in the world, this is actually the way that China and Germany and Switzerland and Singapore, all these successful countries, South Korea, actually run their economies. They regard the exchange rate as a really important policy tool, and it's critically important that we do the same. Otherwise, watch for another 10 years of no economic growth for most people, no increase in income, and political trouble stretching away, which is going to affect the Labour Party just as much as everybody else, but it's going to be disastrous for the country.
John, thank you very much indeed for that, and I think that sets up the discussion nicely. I'm going to ask Professor Wyman to respond, I know, from a slightly broader Keynesian perspective.
Yes, I'd just like to go back to first principles to try and put this into some sort of perspective. So when we're asking why people do what they do, why do firms produce, why do they invest, what's in it for them, why do they do it? It's all about an expectation of future profits. If you look at economic theories, what do all the different economic theories of growth, what do they agree on? Well, there's not always an awful lot that they agree on, but there's a few basic principles that growth has something to do with investment and something to do with innovation. So investment in capital, machines, IT, new technology and so forth, and also investment in people to try and increase skills. It's also to do with innovation. new technology, but also doing things differently, doing things better. So they're the two basic principles that I think we start off from. Firms do things because they expect to make future profits, and when you look at the sorts of things that drive growth, it's investment and it's innovation. So if you try to work out how government puts forward an economic strategy, a macro policy, to try and encourage investment in innovation, and as John said, investment in the UK has been far too low for far too long. You just look at the long time series, and we come well in the bottom third of most OECD countries for these sort of things. What drives that? What drives the expectation of future profits? Well, it's demand. It's not the supply side. That makes a difference at the margin, but it's demand. Demand is what makes firms think, oh, I can sell these things. I will now produce more output. I will invest in new factories, new machines, new people. I will train my people better, and I will produce growth by so doing. So the foundations of any proper macro policy that wants to go for growth is a Keynesian policy. Now, I do wonder in the labour movement whether we've kind of forgotten a bit about that. That used to be our heritage. Things changed in the 70s when people lost a bit of confidence about that sort of thing. But that's first principles. That's why people do what they do. And so we have to put the management of demand in the economy, making sure there's enough of it to encourage people, to encourage entrepreneurs to do what they do, to encourage firms to invest, to encourage people to innovate. We have to put that at the centre of all of this. Now, moving on to the exchange rate, why is that important? Well, partly because that's a component of demand. Big trade deficit means that we are losing part of our demand, and so actually if you sell more and you reduce the trade deficit, you will have a higher potential demand in the economy, and it won't be consumption-led demand, it'll be the sort of demand that encourages people to invest and to innovate. Partly it's because a large trade deficit, as John was saying, 3.5% of GDP, approximately, is simply too large. It's got the potential of constraining growth over a long period of time. So to try and get away from the trade deficit, you need to sell more abroad. How do you sell more abroad? Well, in the short term, you need to sell more of what you currently do. And the only way of doing that, realistically, is to either form new trade deals, which may or may not happen after Brexit, who knows. But the easiest way is to actually have a more competitive exchange rate and to try and encourage your existing producers to sell your existing products, which is what's happened since the European referendum. It's gone, the trade deficit's fallen from 4.5% to 3.5%. Not enough, but it's a start. So a competitive exchange rate does work. But when you also look at that experience, you also realise why you need more than just simply devaluation, or you need more than simply managing the exchange rate. It has to be part of a package. You see, when you look at what the firms have done since the value of sterling fell, roughly half took that in form of profits. They didn't say, oh, excellent, I can expand output, I can make new investment. They took it in the form of profits, said thank you very much, paid it to shareholders, and happy Christmas, everybody. So you need a set of policies around a competitive exchange rate to make them work, to make it work more effectively. That could be a long sustained management of demand to encourage people to invest and innovate. That would help. It could also be that people might want to look at the taxation of dividends to encourage firms, when they get these advantages, to use it to invest and to grow rather than simply to pay all the stuff out in some kind of quick one-off event. So there are ways that you can try and surround a competitive exchange rate, but it is important. It's important because if you simply raise the level of demand in the economy without dealing with these sorts of things, you'll suck in more imports and make the trade deficit worse. But that's not enough. You see, we don't produce enough. goods and or services, but certainly in terms of goods. We need to produce more in the UK. And that's why the industrial policy is so important as part of this process. You see, it's a package, it's not an individual thing. Industrial policy, if you aim it properly, should encourage new markets, new industries, looking at new technology, new potential, things like graphene, things like batteries, things like renewables. We should be looking at those as potential growth areas in the future and saying, you know, we should be in there. We shouldn't be watching other people do clever things with our ideas. We should be making these things ourselves, and we should be exporting them. The trade deficit will come down, the manufacturing sector would rise, the economy will be better balanced, and we would have the greater potential for growth. So an industrial policy is an essential part of this. So really, just to sum up, looking in first principles, you need to encourage investment and innovation. To do that, you need an aggregate demand management policy, a Keynesian policy, not trying to equivocate against that. That needs to be the centre of what we do. You need a competitive exchange rate to ensure that that doesn't suck in imports and you can expand and use the expanding output in the rest of the world, reduce the trade deficit, and at the same time you need to expand what we do, what we produce, and for that you need an industrial policy. It's a package, and that package should be at the heart of whatever Labour comes up with in terms of its macro policy. Thank you.
Well, thank you very much indeed for that. Vicky, obviously you've worked directly in the Department of Trade and Industry on all these things, and as I know the Government Economic Services had a long-standing perspective on all this. What's your response to this?
Well, I mean, the first thing to say is that, of course, having more demand in the economy is a good thing, and it will create more jobs without any doubt. So I agree with that conclusion, especially since all the focus that we have now for quite moderate growth of the economy, certainly over the next 5 years, if you look at what the OBR has been forecasting. But I think the main problem of the UK economy is that it is quite unproductive by comparison to other countries. So John spoke about Germany and others. Actually, in terms of our output per man hour, we are something like 25% below where the Germans are, and that's a serious issue. So if you are in that position, then you may be thinking that perhaps we need to do something to improve our competitiveness. And one of the things you think about is perhaps doing something about the exchange rate. So I'll get back to that in a minute. But where we have seen better performance generally has been, of course, in the financial sector and services in terms of exports, where we have a surplus, whereas because we're uncompetitive in manufacturing, we have a big deficit still. Now, manufacturing is good, so we need to think about ways of supporting it, and it is good because it is actually more productive, strangely enough, than other parts of the economy more generally, such as the gig economy, Uber cars, and so on. And also, it tends to export more, and therefore it's good in terms of the productivity that it would have eventually if it actually does it right, and the way it spreads through the economy. So, and also, it's very important in some regions. So rebalancing it and having some regions have, again, more vibrant manufacturing sector is something that we've actually seen in recent years, interestingly enough, and it has been caused partly by the fact that the exchange rate did fall by 25% at the financial crisis, after the financial crisis. However, there is a limit to how much you can do that. And what's been happening since the referendum is that, of course, sterling has declined by a further 20%. We have not seen that change in exports that we were hoping to get. There's been some increase, but not very much. What we've seen, of course, is that imports have become incredibly more expensive. What's been going on in the past few decades is, of course, that we've become much more globalized, much more interconnected. The supply chains are all linked to each other. So much comes from abroad that goes into our production process. Even though car production has gone up, a huge amount of what goes in it comes from abroad. So the cost of that is increasing and has increased. Input costs went up significantly as a result of the devaluation of the pound. And any increase in manufacturing output that we saw early on after the referendum vote was not meant necessarily by hiring lots more people. In fact, if you look at manufacturing employment, if anything, it's been going down because, of course, companies continue to try and be more productive, save on all sorts of things, robotics, artificial intelligence, and so on. So, in fact, the cost is quite significant. And And it's a bit of a shame because actually, contrary to what John Mills said, in terms of our wage costs and all the other costs around it, we're considerably cheaper than Germany. Because what you have in the continent, Germany, France, and so on, is you have to add all the extra social costs that companies have to pay, which increase wages very significantly, the actual cost that they have. So in theory, we should be doing reasonably well in terms of attracting business here. And we had done it before. FDR increase contributed significantly to productivity growth here, even though we haven't done that well. But overall, it would have been worse if we didn't have them. The question is, by just altering the exchange rate, what difference it makes. Yes, in theory, as John is saying, will make you more competitive and exciting. But because of all the extra increases, as I said, in input costs, it hasn't had that effect. And if you look at manufacturing, in the last 2 quarters and the last month, in July, where the data is now available for this just quarter, which is just finishing, we have been in recession in the manufacturing sector. Manufacturing output, in case you hadn't realized it, has been falling. It fell for 2 consecutive quarters, despite the exchange rate help, and it seems to be falling again, certainly at the beginning of the quarter that we were in right now. So the impact hasn't really been felt. So I think there is a limit to how much you can do with it. I think we probably have seen the limit, and now we need to worry, because a weak exchange rate, of course, also means high costs for consumers, all the imported things that we have. We've seen what happened to inflation. You've seen the reduction in real disposable incomes that came as a result. And firms that are very competitive and know that the consumer hasn't got that much money to spend is not going to offer the high wages that John would like us to see. So actually, a devaluation of the pound has not been helpful in that respect. And then finally, what does it mean if we take that as policy, to continuously be reducing our exchange rate to just remain competitive? It would mean very weird things in terms of how monetary policy is conducted. It would mean that we need to keep interest rates very low, good perhaps for some parts of the economy, but it's terribly distorting, very bad for pensioners and so on. But of course, if the exchange rate starts to go up for whatever reason, politics. Let's say we decide to stay in the EU, the exchange rate goes up very significantly. Do the monetary policy authorities come and slash interest rates and maybe turn them back to negative? It makes no sense in terms of the growth of the economy. It's very inflationary, and of course the consumer at the end of the day is going to be the one that suffers. So if we are to be having a policy to encourage manufacturing, which I think is good news, if we're able to have a proper policy, and I've written a number of, or helped to write a number of industrial strategies in my time, then I think we need to think much more about what Professor Wyman said in terms of how you incentivize people with capital allowances, extra benefits for firms to do it. I'm afraid we'll have to rely a lot more on the private sector rather than less on the private sector, as long as the finance is available, maybe through some sort of state bank or something. But actually we need to see what it is that you can do to incentivize that production and productive capacity to increase. The exchange rate manipulation, which of course leads to huge trade wars, and we've seen what's going on right now between the US and China that affects us all, is not the answer to our problems.
Thank you very much for that. That sets us very nicely to ask Tony Travers to actually comment. And I think there's something that's come out of the discussion so far. We've actually had a Keynesian agenda of increasing demand with the industrial strategy. And one of the observations that John made before you got here was that we need more investment, but it's certain kinds of investment we want. And I think you offered an element of scepticism about some aspects of public sector investments and the returns are on it. Now, with your own interest in the public sector, you may have some thoughts on that. So, very welcome.
Well, thank you, Warwick, and I'm sorry I was late, and I'll speak briefly about a number of aspects of this which I know have been touched on, or what I'm guessing have been touched on. You will all know better than me. The first is on the issue of exchange rates and targeted exchange rate policy. It is interesting how, over time, certainly over my lifetime, this issue has come and gone. Sometimes governments think targeted exchange rate policies are a good thing, and others floating exchange rates are seen as the acme of good public policy. And a bit like other targets that, who remembers the money supply, that governments target from time to time. Sure, all of them have knowing what they are and knowing what we're trying to do, it seems to me, is rational. But if you look across the territory since, let's take a year not at random, the devolution in the late 1960s, I say this issue of whether using the exchange rate and managing it as a mechanism to do something to the UK economy, like other things, comes and goes. And it just is one of those things that comes and goes. We've reached because of Brexit, a point where we need to think about the future of the UK economy more than we normally do. There's been a tradition in British politics, I think, probably more on the centre-right than the centre-left, but it's present on both sides of the political agenda, of the political spectrum, to allow, just to let the economy do what the economy does, quite freewheeling, pick up exchange rate changes where they occur, changes in global markets where they occur, general liberalisation, leading the EU single market policy, now pulling out of it. It's not exactly consistent over time. It just, But what I do think is intriguing to me about this disruptive, I say critically, I don't mean critical of it, but this disruptive moment, is that it will test, it might give the voters a sense of how radical economic change can affect their lives, which generally governments seek to protect them. I mean, I want a Brexit that works for everyone, carries within it the idea that any policy can, by the good activities of government, be made, be managed, be handled so that there are only gainers and no losers. So I think that the challenge that both moving to a new exchange rate policy that I know John is in favour of, but also separately Brexit, which has induced part of that accidentally, is, how much change do politicians think the economy, but therefore people whose lives are the economy, will take? And I don't think we know the answer to that question. Would a radical change to the British economy with large numbers of losers and gainers lead to a political reaction that we're comfortable with? And I say I don't know the answer to this. Just let me finish by saying, as we leave the European Union, and as the UK government has to reset our trading relations with the rest of the world, one by one, every single trade deal they do will have a different effect feeding back into the UK economy. Aerospace will affect the West Midlands. Deals done with countries about aerospace will affect the West Midlands more than they affect London. Future financial services will affect Edinburgh, London and Leeds more, and so on and so on. For every deal with every country. Ditto migration policy. So we are going to find out, I think, as these impacts feed back into the economy, how far national government and therefore subnational government can or should take steps to mitigate it. So I'll leave you that question. Should government take steps to mitigate radical economic change, if radical economic change, as with the change in exchange rate policy, is something we're seeking to deliver? Because there will be losers and gainers. And as in all political life, losers react and gainers don't. Thank you.
Lovely. Well, I think the panel sets us all up nicely for you. So now it's your turn. Who would like to kick us off? Gentleman over there. Hang on, microphone, and give us your name and where you come from. That would be lovely. Yeah.
Dave Hart. I'm a member of Northbrook CLP and also membership officer for Labour in the City. I just want to make a point on I think it was Professor Wyman who talked about first principles being that companies invest for future profits. And I think what we've seen in the last 10 years is some of the very big global digital companies, you might describe them, haven't really been doing that. They've been investing to wipe out the competition. And then, you look at the Amazons of the world, the Ubers, who are potentially trying to sort of dominate the world of most manufacturing eventually. And there's other areas as well here. I'm sure there's a few people here staying in Airbnb during the course of this week. Those are hugely disruptive. So my question would be, what should government do in that?
I'll take two more. Lady in red directly in my line of sight there.
Vicky CLP and former member of the IOD and business owner. I'd like to look at in more practical ways what an incoming Labour government could do to incentivise socially responsible businesses that pay their owned company into employee ownership, I paid the same rate of capital gains tax, even though we were paying the cleaners a living wage and so on, as if I'd sold it to a corporate that was engaging in tax evasion and tax planning and money leaving. It seems to me the UK economy is much weaker because so much money is leaving, not enough inward investment, and the gap between the haves and have-nots is getting greater.
Very good.
Money in too few hands. So I just like to know in much more practical
A
detail.
third question, and
Phil Bear, Solihull, CLP. It's a question to John Mills. When you mentioned about the type of investment, and public sector investment isn't necessarily the best sort of investment, could you comment on the type of investment the Labour Party is talking about in terms of its infrastructure, its roads and training, etc., and to what extent do you think that the mix they're talking about is not correct?
right, shall we kick off with John answering that question and have a go on any other one you fancy, and then we'll work our way through.
Okay, well, I'm not at all against investment in road and rail and hospitals and schools and everything else. What I would say to you is be careful. That is not going to push up the growth rate. It's very important socially, but it's not going to achieve very much in terms of raising the growth rate. And so what you need is a balance. What I think you need to do is to shift about 4% of our consumption into the really high-powered investment I was talking about, probably another 4% into the sort of investment you were talking about there. Then you're getting somewhere close to the world average, and then you start getting the growth rate up from 1.5% per annum to 3.5% per annum. So I think Phil's absolutely right too. You need a balance between demand side and supply side. The problem with UK policy is it's all been demand side all the way through. And in my judgment, most of the problems that you see on the demand side, short-termism, lack of education and training, low investment, all this sort of thing, are consequences rather than causes of our low growth rate. What is the cause of our low growth rate is the fact that investing in the really high-powered types of investment is just uneconomical in this country. If I can just take one point Vicky made, if you look at all inputs from manufacturing, on average, about a third of them are imports at world prices. 2/3 are domestically incurred costs. Wages and salaries, overhead costs of all kinds, taxation, interest charges, and all the rest of it. And it's getting that 2/3 down to being charged out to the rest of the world at a more reasonable level is what you need to do to get British exports and manufacturers back in the frame. So I'm not at all against investment in schools and hospitals, all the rest of it, but it's got to be a balance, otherwise the economy won't grow.
Vicky,
I'm sorry, just on that one, of course, despite the worries that John has, we have actually been the largest recipients of foreign direct investment for a very long period of time in the world. So something works here. Maybe what works is that we're actually not very expensive in terms of hiring workers, and that may have been something which is a problem. I mean, right now we're subsidizing, that's one of the ways of moving things around perhaps, we're subsidizing low pay, which is given by employers through the tax system, which is pretty bad. So we're subsidizing companies to pay very little for workers, and then we ourselves are putting the extra money in as taxpayers. So that obviously needs to change to make it more equitable and also not so hard on the public person. If we are changing that, then you can actually do all sorts of things in terms of the extra spending that's required in areas like infrastructure, education, health, and so on, up to a point. So that's my response.
I'm very conscious we've got also two questions slightly away from the exchange rate on the predatory investment question, and also how do you make the framework of policy more conducive to things like social enterprise? Phil?
Yeah, I think starting with your point, when I was saying go back to first principles, is why do companies do what they do? Supply side things, cutting taxes, affecting costs, yes, they make small differences, but that's relatively marginal compared to what's happening in the world of demand. If the demand for some of these big tech companies wasn't there, they wouldn't do what they did, whether they were still as predatory as they've proven to be. They obviously have a long-term strategy, which is trying to maximise their profits at some future point in time, and they're trying to wipe out the competition. To that extent, you might be able to intervene in terms of competition policy, but we are starting to move away from the the growth agenda here. The cooperative point, I think, is very interesting and very important, and there are a number of different things. You could make it an awful lot easier, actually, for organisations, for banks, or even state banks, if we're going to have a state bank, or cooperative banks. I don't mean the co-op bank, but cooperative banks, and other organisations to actually invest in a lot of cooperatives. You can also look at my local council, where I work, Preston. It's got a very interesting model which is trying to encourage an awful lot of local growth, local development through using the medium of cooperatives and social enterprises as part of its development, and using anchor institutions to try and to stop leakages from the local economy. That's a very interesting thing on a micro level, and I did notice, just as a matter of interest, advertising other people's things, there's a couple of sessions on this at different fringe events later on. So, interesting questions, guys.
Okay.
Well, on the linked questions about what Warwick calls predatory companies, global companies perhaps, and the payment of tax by smaller companies in the UK as compared with that kind of company, I suppose that simply begs a question, to which I don't have the answer, about how to regulate companies that are effectively bigger than nation states. It's a broader issue. It's to do with how there are companies there which are so big and whose products are so admired that it's very hard for any country to regulate them. And I will leave the question hanging in the air of whether Britain doing it alone will find it easier to do that than it was for Britain doing it inside the EU.
Right, so another round of questions. Gentleman there.
Hi, I'm Ollie. I'm a journalist for Citywire. It's been said that no economy and no company is sustainable if the planet is not. How do we raise growth while not destroying the Earth?
Yeah.
Charles Owen from Streatham CLP. Just interested in the structure and ownership of companies, particularly relating to the Companies Act. Does the panel think that there are policy instruments that could be used to get firms to focus on more long-term rather than short-term thinking, particularly into regards of whether short-term shareholders have the same rights to vote in the company as longer-term investors?
And a hand right in the middle.
Phil Brickell, Wood Insurance Sale CLP. The Shadow Treasury team have made a lot about boosting Treasury receipts by going after tax avoidance, tax evasion. Just welcome general thoughts on that and how that can be reconciled with the growth agenda.
John, I'm very conscious that you're probably the only one amongst us here who's actually had to form and manage a very substantial business and think about the Companies Act and how you might structure the shareholding. What practical suggestions have you got in response to those questions?
Well, on the Companies Act, I think there is a case for having a different Companies Act from what we've got, which is very much biased towards the shareholders' interest rather than everybody else's. I think we could have a Companies Act which gave more prominence to suppliers and customers and staff and all the other people who've got a very strong interest in the company. And I think this is to some extent reflected in the bankruptcy laws and all the rest of it. So I think a different sort of Companies Act would help. Just on the other points that were raised, on growth on the planet, I think the big limiting factor on growth is going to be population. And I think one of the problems about population is that the number of children that women have falls precipitously once you get up to a living standard of somewhere around about $3,000 a year. Now, you've still got large sections of the world, particularly in Africa and Southeast Asia, where the living standards are well below 3,000 a year, and you've got growth in population running at somewhere around about 4% per annum. Now, this is really the real pinch point. And I think if you really want to save the planet, the best way of doing it is to raise their living standards and reduce the number of children they have, so that the total number of people in the end, when it plateaus at somewhere the right side of 10 billion rather than way above it. And then finally, there's a question on the tax evasion. Every government promises they're going to do something about tax evasion, and you know, if only we could, that would be a great achievement. The problem we've got on tax evasion is that a huge amount of it is actually legal in a strictly legal sense, because of international agreements which need to be altered. So what I would say on tax evasion is, yes, the Labour government or any government should do whatever it can to try and stop this happening, but you're never really going to be able to do this on the basis of tax evasion in one country. It's got to be done on a world basis, and it really should be. But I do think there's a lot the British government could do. I mean, we are great tax evaders in the UK. The city is a great tax evasion haven, and so are a lot of the Commonwealth countries that are still there, the Virgin Islands and the Channel Islands and all the rest of them. So there's quite a lot we could do, but the really big things require international cooperation. Okay.
I mean, any government is going to try, the present government has tried to do something to reduce tax avoidance and evasion. And as John has just said, it's a rational thing to do. And you know, UK's record, as John has implied, is a bit checkered over time. However, I do think it would be wrong, and I know nobody's trying to do this, to pretend that we can have a bigger state by just tackling tax avoidance and tax evasion. The only way to have a bigger state is to convince more people to pay more taxes in order that public spending in a deficit-free world can rise. And politicians of all parties have proved incredibly unwilling to do that, other than to talk about taxing the richest people. And you don't get much tax, may not be popular at this party conference, you don't get much tax out of only taxing the top earners. So if we're going to have the kind of bigger state that public opinion seems to be shifting a little bit in this way at the moment, then whilst reducing tax evasion and avoidance would help, it would not go anywhere near close enough to raising the money just to have a state that's averages about 43–44% of GDP, which is what Britain's state has typically been. At the moment it's heading for 37%. If we want to change that, then I'm afraid taxation would have to be made popular, and not only for the rich.
Phil?
Yeah, I think the tax avoidance question, it does have to be done at international level because it makes it so much easier. I think what you could do in the interim and in working towards that is getting people and some of the protectorates that Britain has to actually be a little more transparent in terms of opening their books. That might actually deter certain people from trying to avoid things. You might also look at some of the various shell companies that people set up. A while ago I was rather interested in looking at one of the large supermarkets, and they're a very interesting array of different companies that were set up, and it was very difficult to try and work out why they were doing that if it wasn't simply to try and avoid tax. So there are limitations that you can put on organisations doing that. The Companies Act, I agree. I think that there does need to be some reform there. I think people like Will Hodden years ago made some really interesting points about short-termism and long-term investors and how you have to try and encourage greater long-term investment, and that should make a huge difference in how companies act. And one of my colleagues at work who writes on corporate social responsibility would be delighted with the idea that companies should move away from Friedman's thing that the only thing that companies should do is try and maximise profits. I think probably, hopefully, even most of the company owners think that they perhaps should have a wider social interest than that. Sustainability, quite right. One of the things I said when I was talking about industrial policy is one of the key areas where you should try and develop new markets would be in the renewable sector, would be in battery technology. Why is that important? Renewable energy has to go somewhere. Batteries have to be more efficient to keep it. Cars, if we're going to go to electric cars, they have to be more effective, they have to be more efficient because they're too darn expensive. So those sort of areas are areas where you could have an industrial policy, you could try and build an industry, and then you could use the competitive exchange rate to try and sell it. And I think all of that growth agenda doesn't have to be against sustainability, it could promote it if it's done in the right way.
Vicky?
Just to use some comparisons again, I mean, first of all, to remind everybody that Gordon Brown actually did try to have in the company law, the Company Act, a requirement by firms to respect sustainability in their reporting, certainly, and whatever they were doing, so they'll be judged by that. So it covered all the areas that we worry about, environment, employees, and so on. But at the last minute, because of objection by the CBI, you remember in fact, I was on a platform about to announce the new deal, if you like, and then we were told that actually we had capitulated, and it became a much more watered-down version in terms of the reporting that companies to do. So therefore, everything continued to be just as it was before. So it needs to be tried again. I agree with that entirely. But you can do all sorts of things. You can have worker representatives. You can have a lot more democracy in your firm. The way that Germans do, and we keep saying, like the announcement today in the Labour Party about having worker representatives on boards and shares and what have you. And look at the German companies and how, thinking about sustainability, how they cheated the system. They knew they were doing it, or perhaps some people didn't know they were doing it. It's no guarantee. Something else needs to be there to prevent that from happening. And it is worrying that in those environments which we admire, this type of corruption can still happen.
I used to be a Treasury official, and I say that there's a very serious tension between the revenue you want to finance the public services we all need, and using tax as an instrument to stimulate certain forms of behaviour and merit goods and positive externalities. You erode your revenue base by doing it, and a large part of my year is spent talking to people like the Institute of Chartered Taxation and the specialist tax branch of the Chartered Accountants. And what they spend their time doing is rearranging their affairs so that whatever they want to do, whether it's good, bad or indifferent, happens to suit the Finance Act of the day. And many of the complaints that I think people at the Labour Conference have and other conferences have about the tax base being eroded, the more adventurous you get pursuing the sorts of ideas that the lady at the back asked about capital gains tax and social enterprise, the more opportunities you give for companies to actually game the system in an aggressive way with their advisors. So I think we've probably got time for another quick round of quick questions. Gentleman there, whose hand is easiest to the microphone, then gentleman there.
Les Matty from Somerton and Froome CLP. I think one of my ambitions was to pay a load of tax. You know, I wanted to. I can't understand why tax is to be avoided. You know, I always wanted to pay loads of tax. It was one of my ambitions. However, what I really wanted to ask was, what is the best measurement of a successful economy with reference to the national economy? I think it may have been you, John Mills. Did you write once that a good measurement would be the total of everyone's current accounts, for example?
No, it's a very neat question. Gentleman over there.
I wondered if the panel could explore the tension between regulation and driving economic growth, because that seems to me that regulation can drive innovation, but we do tend to have pushed towards deregulation. So an example would be the Code for Sustainable Homes, which Labour brought in, which actually was driving real innovation in the building sector, in environmental materials, and then has been abolished and has sent the industry into disarray, and we lose an export advantage in the development of new materials.
And there's a question, I think, from the lady directly in front of me there.
Yeah, just about the also we need to improve living conditions in the developing world. What does the panel think is sort of what's the best thing that the UK government / the Labour Party should be doing to bring that about? Because that's a very big task.
Right, I'm going to ask the panel to go, starting with Tony, and work that way.
Right. Best measure of, I'm not going to do all of these, because frankly I'll leave my colleagues to think of brighter answers than I'm going to manage. I mean, on the regulation point, it's a very sophisticated and interesting question, this, because some forms of there's a, I saw some polling recently showing that the British are quite comfortable with more government intervention in the economy, but they're very unenthusiastic about regulation and red tape. There's a sort of British cultural thing about red tape and regulation. However, the point is well made. Some kinds of regulation can give a country a competitive advantage. Just it's, the point is, the challenge is to choose the forms of regulation that make an economy function better and more competitively and allow exporters to be more desired, or the exported goods to be more desired, as opposed to kind of regulation which simply impedes people doing their business. And, you know, and clearly whatever is done by way of regulation, what it doesn't need to lead to is people moaning about, you know, filling in forms and being impeded in doing the things they want to do with their lives. That was a simple way of putting it. Which doesn't mean all regulation is bad. Clearly, regulation, we all rely on regulation to sit comfortably in this room, for example. And then, best measure of a good economy, was that the question? Did I get that right? I think, oddly, political scientist, I think the best measure of a good economy would probably be one where, as it were, the largest number of people reported they thought the economy was being managed reasonably well. It's a slightly utilitarian way of doing it. You know, we now know that people are unpromptedly telling Ipsos Mori that they're worried about the broader underpinning of, you know, the quality of government and politics in Britain, which is definitely not where to go. So, I mean, of course there are other ways you can impose external views about what you or I think is a good economy, good for Britain, good for people in Britain, good for the world, good for the environment, good for whatever you like. But I think within any one state, I think the more people assent to the economy that they live within, and the more they're comfortable with it, the better the society would be. Phil?
Some of these are really good questions, actually. Right, let's start off the measure of a successful economy. Richard Layard's done some very interesting things on happiness. I find that really difficult to measure, and I think he's been very creative in how he's trying to measure happiness. And I suppose if you go back to the American Constitution, the greatest happiness or the greatest number or so forth could be an interesting measure. Being an old-style Keynesian, I would always look at the fact that I think we should have a full employed economy. I think everyone who wants to have an opportunity to work and to contribute should be enabled and facilitated to do so, and therefore I would always put full employment at the heart of any kind of macro policy that I was in charge of. And I suppose since I left school in the early 1980s and didn't get a job because there weren't any jobs, I suppose I would think that, wouldn't I? And that's perhaps why some economists who are 10 years older than me regard inflation as being the number one evil in society, whereas I regarded the waste of my schoolmates as being a far greater evil. Regulation leading to growth. Yes, there are some wonderful examples of how that can happen, and there are some wonderful examples of how regulation can stymie the most innovative and creative possible businesses. It has to be done sensibly. I think if you treat the analyses that government departments have to do before they bring in a regulation, you can look at the actual impact that they find the regulation is going to have. And this is a bit of a self-fulfilling thing, because if I'm working for the organisation that's going to bring in a rule, maybe I do find, or have an incentive in finding, that it's going to be worthwhile. But most of those have an effect that it's supposed to boost a positive effect from regulation of around about 2.5%. So, at least if you believe the civil servants, regulation does have a positive effect on the economy, but only if it's done sensibly. Therefore, if you put new regulations hand in glove with things like an industrial policy, you're trying to develop new markets, you're trying to develop new things, new industries. You can bring in new regulations that facilitate and help that sort of thing, while also trying to stop the bad things in the economy and trying to stop negative spillovers, then I think that would be a positive thing for growth as well. So it's not simply about liberalisation and deregulation. Re-regulation can actually have some positive effects, but like Tony says, it has to be done sensibly. Improving living conditions in the developing world. Obviously, aid is important, obviously trade is important, and if Brexit does go ahead, I would suggest that a fair-minded government should be looking at using any new trade policy that it has the opportunity of having in promoting things, particularly in the developing nations, and giving them actually a fair chance. So I would suggest a bit orthodox, but there we are.
No, nothing wrong with orthodox. John.
First of all, on what's a good economy, I think the trouble is there isn't a simple answer to that. It's a number of different things. Obviously, I think it is full employment. I do think it's a reasonable rate of economic growth. 3 or 4% would be my sort of area to be in. I think it's very important it's sustainable. I do think the notion of happiness is a very important one. Social equality. One of the big problems we've got in this country is enormous disparities between the regions outside London and those within it. I think a lot of areas around there are very important. So I think the idea that there's only just one metric which you can measure economic success by is wrong. There's a whole range of different things, and that's just one of the things that makes economics and economic policy so complicated, is that there's a range of targets that everybody wants to aim for at the same time. On regulation and growth, I think on balance probably regulation is pretty neutral as far as growth is concerned. I must say the people who say that if only we could get rid of regulations, the growth rate would go up by 2 or 3% per annum, just not in the real world at all. One of the problems about regulations is they all benefit somebody. And the people who are going to lose out if regulations go scream like stuck pigs, as Tony said, whereas everybody else who pays the cost, millions of people paying a tiny sliver of the cost, don't say anything at all. So getting rid of regulations actually is very, very difficult. But most regulations are there for a reason. And I think, therefore, that the scope for getting higher economic growth by scrapping regulations is minimal. But I do think also that the idea that you're going to improve the growth rate by really changing regulations substantially is probably a drift as well. And then finally, as the question of the third world, aid and trade are obviously both important. I must say, I think actually trade is probably more important than aid. I mean, if you look at what's happening in the world, and particularly this is an issue around the, but I don't want to discuss Brexit here, but on a specific issue around the EU, one of the problems with the policies pursued by the Western world is by restricting the importation of food products in particular, but manufacturers as well from the third world, but actually impoverishing people to a greater extent than we're benefiting them by aid programs. And it does seem to me the balance there is really wrong. That what we really ought to be doing is being more liberal as far as trade is concerned. I'm not suggesting that we should scrap the aid programs, but I do think if you really want to make people in the third world better off, giving them better trade opportunities are probably the best single thing you can do. Vicky.
Okay, on what is the best sort of model for an economy? I mean, there is a question of inequality. And I think what we find is if you look at different countries and you look at the rates, the level of inequality that exists, or the coefficient that shows you that, you don't necessarily see that in the short term in terms of growth per annum. But what you do see, and this is the likes of Krugman have written about this, is that if it persists, then what you end up with is social divisions, social concerns, which therefore in the end mean people don't want to invest in that country, move the money out, so you actually end up with lower growth and fewer people employed and therefore more unhappiness as a result, if we really believe that employment and happiness are all linked. But we have a problem in the UK. Quite a lot of the very happy countries are countries where there is a lot of cooperation. So the various bits of the economy really work well together. Politics works well with individuals, works well with business. We are not a very cooperative country. In fact, if you look at the World Economic Forum league tables, we're almost right at the bottom in terms of how cooperative we are. That means that there is strife all the time and therefore less happiness, and the solution to what will make a happier country just doesn't come out very easily, unfortunately. On regulation, quickly, the interesting thing is that everyone talks about regulation, but actually we are, again, one of the easiest countries to start a business, one of the easiest countries to do business in, one of the ones that has the least product controls than any other, not controls necessarily, but in terms of all the extra things that you have to prove and the restrictions, etc., because it's not just what happens in the EU, it's also what happens internally in terms of the way you go open on Sundays. We are much freer, for example, than many other countries. So actually we are less restrictive, much less restrictive. So we start with quite low regulation, and we need to bear that in mind. So there is a limit to how much more you can cut it. but as others have said. But the interesting thing is that where we are very good, and again we rate very highly worldwide, is in competition policy. We actually do go for the big boys. We may not have managed to get enough tax out of the big international players, but my God, we force supermarkets to do various things. We break up banks if necessary, etc., or make them pay fines if they are abusing the system. So actually we're very good at that, and that's something that needs to make us happy. But in relation finally to what to do with developing countries, the question which each of us has sort of tried to answer, the answer is trade, of course, but I was just thinking, given where we started, that if we are trying to be as well as we possibly can in terms of our current account, but just continuously cutting our exchange rate and becoming more competitive, how on earth can you help those countries that really need to trade with us and sell to us and grow as a result? So there is this huge inconsistency in the argument we've just been hearing.
Well, I think the panel's done very well. We've come exactly to the end. We have 1 minute for John to set us forward and tell us what we should do and where to take the argument in the future.
Well, I am arranging the growth competition, which you can all go into if you want to, with a £100,000 prize for what you need to do with the British economy to get the growth rate up from where it is at the moment, around about 1.5% per annum, to 3 to 4% per annum. And I've set some ideas out for you today, but I think there may well be better ideas around. But if you want to go into this competition, it's going to be announced at the beginning of October. You've got to get submissions in by early January. There's then going to be an adjudication panel involving some very distinguished people who are going to make up their minds as to who come up with the best solution in May next year. So watch this space, and if you want to come in for it, you can come in either as an individual or as a body, as part of an organisation. But I hope you'll try and see whether you can come up with something that's more spectacular than anything I've managed to produce so far.
Now, that was not a planted question. I promise you, I'm not joking. I was wondering, how can we neatly bring this to end? John egged us on, convinced us, persuaded us to do it, and I just wanted to have a final sort of surmise of what to say. So that was not a planted question, but it was a very, very good answer. So, John, thank you very much indeed. I'd like to thank all the panel very much, and thank you very much for your questions and interventions.